One single pivotal day in the markets, September 3rd, 2025. And we've got this really fascinating, almost real-time look inside a sophisticated trading system. It's called the OMNI Profit Nexus. We get to see how it operated, how it made decisions, and what it termed, a fragile market. We have its actual analyses, the trade readouts, and even, its own self-critique afterwards. Really compelling stuff. So our mission today really is to unpack how this system worked, not just how it aimed for profits, but maybe more crucially, how it managed the significant risks on a day like that. We'll track the journeys of some key assets. Tesla, the S&P 500 index, Bitcoin, see how this digital brain processed it all.
And it really was a fascinating backdrop, that market state. The system classified it as a transitional cautious risk-on regime.
Okay, transitional cautious risk-on. Break that down a bit. What does that feel like?
Well, think of it like you want to accelerate, you see opportunity, but you're keeping a foot hovering over the brake. There's this underlying desire to take on risk, but it's heavily tempered by caution signs.
Got it. And the big caution sign was?
The VIX, the volatility index, was sitting at 17.17. Now, the system had this defined fragility threshold at 16.5. So being above that, it wasn't just a suggestion. It meant mandatory caution, mandatory hedging protocols were active.
Okay, mandatory hedging. So let's meet the main players the system was watching that day, our sort of cast of characters. First up, TSLA, Tesla. The system called it the amplifier. Why that name?
Because of its high beta, it just tends to magnify whatever the broader market is doing. Big swings, up or down.
Makes sense. Then SPY, the S&P 500 ETF, that's our anchor.
Exactly. Represent the big picture, the overall market sentiment, kind of holds everything together or shows the main drift.
Then we have Bitcoin, Spot, and the ETF Mini. It's the gatekeeper.
Yeah, often seen as a signal for broader risk appetite. Are people feeling bold enough to pile into riskier assets, or are they pulling back? Bitcoin can sometimes lead that charge.
And finally, the VIX itself. Not just a number, but a character here. The hedge or fragility index.
Precisely. It's constantly measuring that fear or complacency level in the market. Crucial for the system's risk assessment.
All right, so let's dive into the morning session. September 3rd kicks off, and it sounds like Tesla, the amplifier, really stole the show early on. The OMNI system flagged it as the key amplifier. How did it track TSLA's move? It went from a fragility wall to a breakout, right?
It did, yeah. So around 10:23 a.m. Eastern Time, TSLA was right up against its $335 resistance. The system flagged this as a key fragility wall, basically a make-or-break point. And the playbook was ready for either outcome. If it got rejected there, a bearish put strategy. But if it broke through, the targets were $337 and then $340.
And it didn't take long for the breakout scenario to play out, did it?
Not at all. Just 9 minutes later, by 10:32 a.m., TSLA didn't just nudge above $337, it decisively broke it, pushing hard towards $340.
And you mentioned volume.
Oh, yeah. Massive volume confirming the move. And interestingly, the price actually punched above its upper Bollinger Band.
Which is a volatility indicator. So pushing above the expected range, that's strong.
Very strong signal. It suggests momentum is really kicking in. Breaking that band isn't common and usually confirms significant buying pressure. And the system's other momentum tools were all flashing green, basically. The MACD histogram, solidly green, rising fast.
Okay.
RSI, the relative strength index, was climbing towards overbought, around 59.1, and the stochastic oscillator was already firmly overbought above 90.
So strong momentum, but maybe getting a little stretched. That overbought signal.
Exactly. Strong move, but it also signals, hey, this might need to cool off soon. Doesn't mean sell immediately, but be aware.
So the system's amplifier logic played out perfectly. TSLA kept running.
It did. By 11:56 a.m., it peaked around $341.50. That's a nice gain, 3.69% for the day at that point.
And the system executed trades based on this, call options.
Yes, it deployed a ladder of TSLA call options, specifically targeting the $340, $350, and even $360 strikes, spreading the bets across potential upside levels.
And the results on those trades?
Pretty remarkable, actually. Yeah. Significant realized gains. The average return on the closed TSLA call trades was around 102.9%.
Wow, over 100% average return.
Yeah, and importantly, a 100% hit rate on those specific closed trades. No losers in that batch.
That's impressive. What was the exit strategy? Just sell at the peak?
Not quite just sell at the peak. It was about capturing profit near peak momentum, especially with RSI hitting 81 deep into overbought territory and stochastic also extreme. The system was designed to close out those positions to lock in gains and, crucially, avoid theta decay risk.
Ah, the time decay on options, especially near expiry.
Exactly. These options only had 2 days left. Theta decay accelerates massively towards the end. Holding on too long, even if the price stays high, can erode profits fast. So all positions were closed. Profit secured, decay avoided.
And you mentioned this wasn't just one exit point. It used a tiered exit ladder. Can you explain that a bit more? How does that manage risk?
Right, it's a disciplined approach. Instead of aiming for one single exit price, you predefine multiple exit points. So for example, Tier 1 might be selling, say, 25% of your position if TSLA hits $340.50 on good volume, maybe take another chunk off at $341, and so on.
Scaling out.
Precisely. You lock in gains incrementally as the trade works. It reduces your overall exposure and your risk if the trend suddenly reverses. It's less about hitting the absolute top, more about banking profits systematically.
Okay, so Tesla's the star performer, the amplifier firing on all cylinders. But what about the rest of the market? Are Anchor, SPY, and the gatekeeper, Bitcoin, were they joining the party?
Not really. Telling a much more cautious story, SPY, the S&P 500 ETF, was basically stuck. It remained in what the system called a neutral defensive posture. It couldn't get above its $643 two's resistance level.
So no broad market confirmation of Tesla's strength.
Not sustainable confirmation, no. The system actually had rules to freeze any bullish scalp calls, those quick in-and-out trades on SPY. They wouldn't be activated unless SPY could hold above $643.02 with strong volume. It was very much a wait and see on the broader market. Don't chase it yet.
Okay, wait and see on SPY. What about Bitcoin, the gatekeeper? Any signals there?
Bitcoin's story that morning was, well, a bit of a disappointment for the bulls, a failed breakout. The BTC ETF mini tried to push above $49.05, but it just couldn't hold it. Momentum turned negative pretty quickly. So it fell back into what the system described as neutral range-bound chop, just bouncing around sideways between roughly $110K and $113K for spot BTC and $47 to $50 for the ETF. No clear direction.
So the system's response?
Went flat. Closed out any Bitcoin positions, sidelines until a clearer trend emerged, no point trading noise.
This caution across SPY and Bitcoin really ties back to the VIX, doesn't it? Our fragility index. How was that influencing things?
Absolutely central. The VIX, even though it eased slightly during the morning to around 17.03.
Giving a little breathing room.
A little, yes. But it was still stubbornly above that 16.5 fragility threshold. So the overall hedge regime remained switched on. Defensive protocols were active.
Like what specifically?
Well, for example, the system was scaling into UVXY $16 call options.
Those profit if volatility spikes.
Exactly. It started with a small 0.25% allocation, but it was primed to increase that to 0.50% immediately if the VIX started to surge again, always keeping that protection layer ready.
And speaking of protection, there was this other rule about the Fed's speech window. That sounds critical.
Oh, absolutely critical. It's a great example of event risk management. Regardless of how any single trade was doing, the system had a hard rule. Flatten all positions between 11:00 a.m. and 11:50 a.m. Eastern.
Just get out completely for that hour.
Completely. Fed speeches can cause wild, unpredictable swings. Doesn't matter if you're up or down. The risk of a sudden, sharp reversal is just too high. So the system prioritizes capital preservation over trying to trade through that potential chaos. Take the risk off the table entirely for that window.
That makes a lot of sense. It really highlights that even with Tesla's win, the underlying market was seen as fragile. And this fragility is where the system's guardrails really came into play. Not just making money, but protecting it. These AlphaCore V3.15 guardrails. What were the key principles?
The number one principle, woven through everything, capital preservation is paramount. Job one is don't lose money, especially in fragile conditions. So this translated into concrete rules. All position sizes were automatically cut back, down by 30–40% from what might be normal in a calmer market.
Reducing exposure across the board.
Exactly. And individual trades were capped too. No single position could exceed 3% of the total capital. Prevents one bad trade from blowing yours up.
These seem like sensible baseline rules. What about specific triggers or stop losses tied to that fragility?
Yeah, the system had very tight discipline there. For instance, automatic fragility triggers and stops. If a position went down 25%, it triggered an automatic trim sell part of it. If it hit minus 40%, hard exit, full position closed, no questions asked, limits the damage.
Disciplined loss cutting. And you mentioned
Yeah.
zero DTE options earlier. Rules for those too.
Very strict rules. 0 days to expiration options are incredibly sensitive to time decay, especially late in the day. So exposure was capped at just 1% per trade for any 0 DTE position. And a hard rule: no new 0 DTE trades after 3:00 p.m. Eastern. The decay risk just gets too extreme in that final hour.
Okay. Disciplined entries, exits, sizing. But what about the ultimate safety net? This kill switch. Sounds ominous.
It is the last resort, designed for truly severe adverse market conditions. It's an automated command that, if triggered, would instantly flat all positions. Close everything, market orders, get out now.
Wow. What triggers something that drastic?
It's not just one thing. It requires a confluence of negative signals confirming likely systemic risk. For example, one trigger condition might be SPY dropping below a critical level like $640 and simultaneously the VIX spiking above 18. Or maybe Bitcoin breaking down hard below $47.05. It needs multiple severe warning signs flashing red at the same time. It's the portfolio's emergency brake. You hope never to use it, but it's there.
Okay, so the day winds down. September 3rd closes. Did the market shake off that fragility? And how did OMNI Profit Nexus end the day, given its controlled fragility stance?
Well, the market closed, but the fragility didn't fully disappear. The system maintained that cautious posture right to the bell, exiting the day completely flat. No overnight exposure. True to its capital preservation rule in this regime.
How did our main characters finish up? SPY.
SFDY, the anchor, closed up a bit, 0.52% at $643.60. But crucially, the system noted it failed to reclaim resistance between 644.5 and 645. So the momentum was still seen as pretty weak. Tepid.
And Tesla, the star of the morning.
Tesla, our amplifier, closed up 1.44% at $334.09. But, and this is important, had a significant intraday rejection wick up near $343.03.
Standing it rallied high but got pushed back down hard before the close.
Exactly, sellers stepped in. And the MACD indicator actually turned negative by the close. Also, that heavy volume for the day, 87.6 million shares. The system interpreted that as distribution, not accumulation.
So selling pressure even though the stock closed positive.
That was the system's interpretation, yes. A potentially bearish sign, despite the green close.
Interesting. What about Bitcoin?
Bitcoin closed higher, too. Spot around $112,248. The ETF mini at $49.72. Mazzy looked bullish. But it was still stuck in that range, capped below the key 113K spot level and the $50 ETF level. So improving, but not breaking out, still range-bound.
And the VIX? Did it stay above the fragility line?
Actually, it dropped right at the close, finished at 16.40, down almost 4.5% on the day. So it dipped just below that 16.5 fragility threshold.
Ah, so the hedge regime turned off.
The system flattened its VIX hedges based on that close, but the final assessment was that the fragility regime was cooling but not resolved, still cautious going into the next day.
So overall, the system gets a B+ execution grade. Pretty good.
Yeah.
3 out of 4 modules worked as planned, the SPY puts earlier. The TSLA scalped the hedge management. Capital was preserved, profits taken on TSLA. But this is where it gets really interesting for me. The system and external analysis of it didn't just stop there. It performed as self-critique. What came out of that meta-analysis?
Yeah, this self-reflection is key. For instance, that interpretation of TSLA's volume as distribution. That sparked some debate. Critics pointed out that labeling heavy volume on an up day as selling pressure without having detailed order flow data could be seen as, well, post hoc rationalization.
Sort of fitting the data to the narrative after the fact. Hindsight bias.
Potentially, yeah, or at least a risk of it. Another point of critique was the VIX threshold. Did the system sort of nudge its 16.5 fragility line definition just because the VIX closed at 16.40, almost moving the goalpost slightly to validate its continued defensive stance?
That's a subtle but important question about algorithmic integrity, isn't it? Can a system develop biases to confirm its own models?
It's a constant challenge. And other concerns surface too, things like complexity overhead. The system uses like 5 or more different analytical layers. Does that complexity actually help, or does it make it harder to understand why a decision was made, potentially masking simpler drivers or biases?
Right. More layers isn't always better.
And then there's the over-reliance on relationships between assets that can break down, especially under stress, and maybe a degree of overconfidence in predictions with those very specific price targets. Markets are messy, right? Pinpoint precision is tough.
So it raises this fundamental question when you're dealing with such complex systems, even ones capable of self-critique. How do you balance the sophisticated data analysis with the potential for these inherent biases or complexities in interpretation.
That's the million-dollar question, really. There's no easy answer. It often requires that human oversight layer to question the machine, to understand its limitations.
What a fascinating journey through just one trading day. We've really seen the inner workings of a system like ONNI Profit Nexus, executing precise strategies like that TSLA scalp, capturing profits, but always against that backdrop of rigorous risk management in a fragile market.
Absolutely. And we've touched on so many key concepts: cross-asset analysis, these fragility walls, the idea of an amplifier asset, and maybe most importantly, the absolute necessity of those built-in guardrails. Tiered exits, hard stops, even that dramatic kill switch. Protecting capital comes first.
For you listening, hopefully this deep dive gives you a real sense of what goes into modern financial decision-making. It's far beyond just looking at a price chart. It's this intricate dance between spotting opportunity and exercising, sometimes extreme caution. Managing risk is just as important, if not more so, than chasing returns. So let me leave you with a final thought to chew on. In a world where algorithms are getting incredibly complex, where systems like this one can analyze massive data and even critique themselves, how much of ultimate market success still boils down to human judgment, to intuition, to our ability as humans to step back and critically question even the most sophisticated black boxes. Next time you see those market headlines, maybe ask yourself not just what happened, but how's that interpreted, and by what or whom?